Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Thank you all for being here, guys. Happy New Year. This is our first Take Back Control presentation of 2025. We are so stoked to renew this presentation for another year. This is going to be a great year. 2025, everybody. What are your New Year's goals? New Year's resolutions? What are we looking to accomplish in 2025 around your life, but specifically money? What are you guys looking to accomplish this year you've never done before? And is that maybe why you're taking time today on this Tuesday afternoon to be on this presentation, to learn something about money you might not have known before? Today, guys, I want to have a very interactive and a lot of communication and interactive chat. I always say this, but the more you guys are on here, the more you guys talk, chime in, and give us your thoughts, emotions, enthusiasm, the more you're going to get out of this. Whether you're at home, or whether you're at work listening behind your desk, no matter where you're at right now, I'd love for your full attention, because the more you put into this, the more you're going to get out of it. And what we're going to talk about today is what's here on the screen today, the money multiplier method, how you can map out the millionaire mystery, and how you can become your own bank, BYOB, guys. We're going to talk about how most of America treats their money a certain way, and I wonder, what if that way we were taught to treat and store and use our money was wrong? What if it was an inefficient way to use our money? We're going to talk about a story today, a story that's 200 years old, a story that's been used and told from generation to generation. And this story is about how the wealthiest families in history eliminated their debts, minimized taxes, and left a legacy. And I want to show you guys how they did this without taking on any more risk, without working any harder, without changing their cash flow, and without even losing control. This presentation today is going to be about how you guys can become your own bank. So let's really dive deep into this strategy. We have 30, 45 minutes. I'd love your full attention. I will be posting this presentation on Chris Naugle's website and YouTube afterwards. So if you're able to, or have to leave halfway through or something, definitely head over there, look under playlists, and look under Take Back Control Tuesday, and this presentation will be uploaded there. Now, I highly recommend you sharing this with friends and family. The more you can bring a community around this strategy, the better you guys are going to be able to do this and have people supporting you with it. Now, those of you who are here for the first time, I saw there were a lot of you, and there's a lot of people in this presentation today. And those of you, this is your first time, you're going to learn a lot. And I'm pumped you spent your Tuesday afternoon with us to be here today. Learn from those in the chat who have been here for a while. They're going to have some great insight and really good questions that might go over your head at first, but that's okay. So today, let's talk about what you guys are going to get out of today. How many of you This is where you guys in the chat liven up, answer these questions. How many of you at one point or another time in your life had no control over your money? If this was on stage, I'd say raise your hand, but got to wait for you guys to fill in the chat. And I assume that's why you're here today, right? Well, how many of you are looking for ways to better control your money and banking in your life? Raise hands, throw it in the chat, all you want. I love it. Yes. Well, that's amazing you're here. Those of you who want that. Not a lot of people do. And wherever you're at on your financial journey, I welcome you guys and I congratulate you for spending your time with us. And I really mean that, because there's so much talk going around. There's so many people out there just yapping. They think they know what they're doing. They claim they want to be better and do well, but they're not here. They're not studying. They're not educating themselves and making their 2025 the best year ever. They're just living a mediocre life. The thing that we all today have in common is that we're here. We're here to learn, and we're giving up our efforts and time to do this. And whenever I step into a stage or I'm on a presentation like this, I always want to start by telling you exactly what you're going to get out of today. When I'm sitting in the crowd, I want to know what I'm going to get out of the meeting too. And so I want to start with 4 things, and I'm going to put them here up on the stage or on the screen. First being protection. Protection, because who doesn't want to protect the money you earn, right? Tax-free growth being number 2. Guys, there's smarter money moves we can make to protect ourselves from taxes that we're not already implementing. Leverage, because kind of same thing. There's ways we can leverage our resources, our money, our life more efficiently. And last is legacy, leaving what you've learned today and what you start to implement today to your family and friends. These 4 things I have a system that will help you accomplish these 4. So if you guys could take home a blueprint from me with all of these things, would that be worth our time today? Everybody, you can put a hand up, thumbs up, emoji, whatever you want. So I guess it would make sense for me to share a little bit about myself, just so you guys who are new to this, don't know who I am. I think a lot of you guys do, but those of you who don't, just share a little bit about myself so you have some confidence in your speaker. So over the past few years, and by the way, this is some photos of my wife and I. Over the past few years, I've built a foundation for my young family to not just be rich, but to build generational wealth. And I can sum this whole experience up with 2 words: gratitude and choices. I'm so grateful that I get to just feel secure and confident in my future. But more than that, I'm grateful for the opportunities I've been given. I've had so many mentors in my young life, and it's got me on the right direction to start my career. And I say choices because I get to choose every single day what I want to do. Most people can't say that, especially people in their 20s. And that freedom in my finances has led to freedom in my personal life. It's amazing. But my story's actually pretty simple. I bet a lot of you actually can relate to it. In my early years, I made a lot of mistakes. We all do. But when I was 18, I went and did a service trip. I lived abroad for a year, and it was amazing. When I came home, I was in school, and I had a lot of outside influences pushing me different directions. I had and kind of held in one hand the traditional route, the route of learning about English, economics, schooling, really being groomed to be good at task doing and being a good employee, and going down the corporate America route. And in the other hand, in this hand, I held real estate investing. I saw business owners and the freedom they had in their lives, the control they had. And I came to a point where I had to decide, do I want to learn to work for money, a part of the so-called rat race? Or do I want to learn how to make money work for me? And it was that tension that brought me to a point of decision. And that decision was to drop out of school and pursue an education in investing and start learning how to make money work for me. And that completely changed the course of my life. But above all, what's most important is family. How many of you guys today would like to have enough money to spend as much time with your family as you'd want? Raise a hand, thumbs up, right? How many of you guys would like to have more money to spend less time with your family? Because there's some of you guys here I always like to say that. There's always a few of you, and that's okay too. But really, today it's about you guys. And so I want to talk about you guys. You guys today here are what I call the 5%. Sorry, excuse me. 5%. And I say the 5% because you're here again. You should pat yourself on the back for spending time here. Most people wouldn't. But when I go around If I was to go find 100 18-year-olds right now and I asked them, would you guys be wealthy and successful by the age of 65? What do you think those young people would say? I bet you every single one of them would say, of course, there's no way I would not be financially successful at 65. There wouldn't even be a question in their mind. But something happens from when they're 20 or 18 to 65 that changes the whole dynamic. According to the Social Security Administration, according to our government, 5 out of 100 people will be financially secure at retirement age. Guys, not rich, not wealthy, not successful, just secure. Think about that. In the great country of America, in the land of opportunity, of entrepreneurship, something's wrong with that. 5% of people will be just secure. And that means 95% of people are going to be out working until they're 65, 75, 85, taking on 2 jobs, not because they want to, but because they have to. Now, you guys, I hope, will turn into that 5%. But the difference between you guys and, again, that 95 is your willingness to invest your time, your money, and your effort to actually learn something new. So let's dive into some 5% stuff today, and let's really teach you guys what to do here, how to avoid being that 95%. So why aren't more people successful? First question. What do you guys think? What are the mysteries of money? There's a few, and I'll highlight them, but why? Why aren't more people successful? I think there are 2 reasons. There are things that just destroy our wealth, and then there's a mindset you kind of have to be successful. Wealth killers being taxes, inflation, and volatility. We can go a whole hour on each of those topics, but the hard-earned money you make, some gets taken for taxes, some gets sent to your 401k, some gets sent to the government, financial institutions, goes to everybody but you last, and then whatever's left over has to fight inflation and volatility for the next 80 years to somehow make it at the end. It's impossible. It's very difficult. And I say mindset because beyond that, if you just choose to follow the status quo and do what you're told and live in fear, you're never going to be successful. And always life gets in the way. So I want to start with this quote today by a guy named Will Rogers. He said, the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. A lot of what we've been taught about money isn't actually the truth. I need you guys to keep an open mind during this presentation because I'm going to challenge the way you think about money. And I want to start with a story. You guys ever heard of the backwards bicycle? I'm sure a lot of you who have been here before have heard it countless of times, but it's a good reminder. So backwards bicycle. If you look here on this photo, it shows the handlebars that they turn right, the bike goes left, and vice versa. There was a guy who did an experiment. It's actually on YouTube. You can find it, where he basically was like, well, hey, I've ridden a bike my entire life. We all know how to ride a bike. Since we were kids, we learned. And he decided to switch the handlebars around so that it was the opposite of what direction he wanted to go. And he tried to ride the bike. He got up, took a couple pedals, fell over. Got back up, took a couple pedals, fell over, thinking, how in the world is this possible? I learned how to ride a bike when I was young. He kept doing it over and over and over again for hours. Eventually he got it. Eventually he could ride the bike. But then he tried to go back to riding a normal bike and couldn't do it again. His mind switched to the new way of riding a bike. It took him again hours to get back to the normal way. And I share this story with you because it's kind of exactly what's going to happen with money. Since we were little, we've been trained how to think about it. We've been trained not to talk about it. But what would happen if I told you what you were taught was wrong? It would be very difficult for you to change to that new way of thinking, right? But it wouldn't be impossible. Eventually, you would learn how to ride the bike backwards. That's what we're going to do today. And earlier I mentioned this is a 200-year-old strategy. Well, let's talk about who talks about this today. First off, all of you probably know this guy, Robert Kiyosaki, one of the most famous real estate investors in our country. He wrote a book called Second Chance, where he talks all about this strategy. There's a guy you all know as well, I guarantee it. You know, Tony Robbins, his book, Money Master the Game, Simple Steps, or 7 Simple Steps to Financial Freedom. He talks about this strategy in section 5. And there's a book by R. Nelson Nash, Becoming Your Own Banker. This book would dive deep into this strategy. This will be the foundation for you to learn this concept, and I would highly recommend getting that book. And then all of you here know Mr. Chris Naugle. These are his 2 books about this strategy. So what are these people talking about in these books? What are the mysteries of money that we're not already understanding? What have we been not taught? And I want to start with some questions to kind of get your mind thinking about what those things are. So the mysteries of money. First off, what's the definition? What is it? What's money? Everybody in the chat, what do you think? I see some people chatting, responding back to me. Not everybody, a couple in the chat. Yep, there you go, Shauna. So the definition of money. Money is just a means of exchange. That's it. Money for food, food for money. Money for car, car for money. That's it. Money for house, house for money. Means of exchange. Now, what if I asked you guys this question? Maybe you haven't thought about this before. What companies or businesses use compounding interest? You ever heard Albert Einstein say the eighth wonder of the world is compound interest? Who uses it? What do you guys think? The most common answers I always get are Wall Street and banks. But the actual answer is not one business. But let's focus on banks because that's the most common answer. Banks, they don't make compound interest. They actually charge you compound interest. They don't use it themselves. Because, for example, if I had a $20 bill, walked down the street to Wells Fargo, gave the teller $20, they wouldn't go put it in the back with my name on it and let it sit there until I want to come back and get it. No, they take that 20, they go give it to the lending department, and it goes to somebody as a loan. They immediately put that money in motion. So there isn't a business in the world that uses compound interest, and nor do banks. They keep money in motion, just like you should. But you haven't been shown how to do that. You've been taught to park your money and leave it in somebody else's control. But today that's going to change. Because what if I was to ask you these two questions? Are your dollars worth more today or in the future? And are taxes going to go up or go down? Well, duh. Your money's worth way more today than tomorrow, the next day, a year from now, 20 years from now. Because how many candy bars could you have bought in 20 years ago for $1 versus today, right? It was worth more 20 years ago. And same with taxes. What would be better? Paying the tax today or down the line? Are taxes going to go up or go down? They're probably going to go up. And if they don't go up, they're just going to find more stuff to tax us on. So wouldn't it make sense to pay the tax today so that it grew? You'd be paying tax on the seed and not the harvest. However, we don't practice that. As Americans, we're taught to put money in a 401k or some employee-sponsored plan. And what you're actually doing is when you put those dollars in that 401k, you're actually giving up today's dollar in exchange for weaker dollars later. You're compounding the tax because the tax is never going away. You're going to pay tax on a larger amount. You won't be paying tax on the seed again. And this is the funny thing, because what people have been taught to do is give up control of their money. And just like I explained a second ago, we've been taught to do things with money that we would never do with things that money even buys. For example, would you guys go to the store, buy a loaf of bread, go on home, open up the freezer, throw it in the freezer, close it, leave it for 5, 10, 15 years and just wait, and then come back, open up the freezer door and get ready to eat the loaf of bread? You would never do that. It'd be freezer burned. What about a car? What if you went to the car dealership, you went to Ford, bought a brand new truck, drove it home, parked it, stoked, went in to show your wife or spouse, and then you let it sit? You waited 10, 20, 30 years and then decided to drive it. We would never, ever do that. But that's exactly what we've been taught to do with our money. We've been taught to give up control of our good dollars today for weaker, higher tax dollars later. So if you want to be good with money, then you need to change who's in control of it. So this is why retirement accounts are such a big conversation, because that's exactly what you're doing. And what do you know about your retirement account? I bet you know very little. I bet you know whether it's in a high, low, or medium risk tolerance. And if it went up or down last quarter, last year. It's probably it. Who knows anything else? So we need to challenge these ways of thinking and start to understand how money really works. So I want to start with a little bit of a money quiz. Just get your minds thinking about how money really works. How many of you guys can make money earning 4% while paying 6%? In the chat, what do you think? What do you think? Can you make more money earning 4 while paying 6? Might not make sense to someone who's never heard of this before, but I'll show you how you can, and it's true. Let's say you want to buy a car. You go down to the Ford dealership, you got a Ford truck or Ford Focus, whatever it is, and it's 25 grand. And you also have 25 grand sitting in your savings account. Okay? And you think, should I pay for the car cash or should I get a loan from the bank and finance the car? What's the better decision? Most people would tell you buy the car cash. But I'm going to show you why that might not make sense. Here's why. Car for 25 sitting in a bank. And let's say your bank account's paying you 4%. You have a super great high yield savings account paying you 4%. So you're making 4% in your bank account, and you choose to not buy the car cash and deplete your savings, but get a loan from the bank for 25 while you let your 25 sit in the bank. So you're going to get a loan for a car at 6% for 60 months. Normal car loan, 5 years. Your monthly payment would end up being $483. Your total amount you would have paid over that 60-month period is $29,000. Following me? While you did that, your 25K sitting in a savings account for 60 months at 4% would turn into $30,525. You can do the math yourself. There's a difference of $1,500. You would have made $1,500 off of buying the car over that 60-month period. So yes, you can make more money earning 4% than paying 6%. And why is that? Because of this simple difference. Depreciating simple interest versus uninterrupted compounding interest. Big words if you don't know anything about money. But when you have a car payment, you pay it down every single month. The balance gets lower, the interest is less. But on the savings vehicle, earning 4%, now it's earning 4% on that 4%, and then on that 4%, it's compounding over 5 years. And so, yeah, over 5 years, you're going to earn way more at 4% than paying somebody 6%. That's why in this scenario, it would have made sense for him to get a loan from the bank. And he had access to his 25K sitting in savings whenever he needed it in case something popped up. So yes, you can. So let's talk about what we're going to dive into today. I know I've gone through a lot thus far, but all basic stuff I want to just get you to wrap your mind around, change your mindset a little bit. Now, the rest of this presentation, the next 20, 30 minutes, we're going to dive deep into numbers, examples, and really show you this method that's been around for 200 years that these families have been using to build wealth. And the strategy is called, obviously, from the beginning, I showed you the money multiplier method. There are 3 things I like to keep in mind that we're going to talk about when it comes to this methodology. One being the machine. You need a machine that your money is going to run through to make this strategy work. Okay. Right now, we use somebody else's machine called Wall Street, called the traditional banks. We're going to change that one thing. It's going to be a new machine your money through, and it's going to change everything. Okay. And 2 is the marathon. This is a marathon method. This takes years to build and time to actually accomplish the generational wealth we talk about. It's not a get-rich-quick scheme. And last, the millionaire. This can represent whatever you want it to represent. I like millionaire because it's alliteration with all these other words on the page. It's catchy. But millionaire meaning your goal. You could be a multimillionaire. You could be a business owner. Have your time back. Whatever that goal is for you. That's what I want you guys to think about is these 3 things. And again, I mentioned this in the beginning, but if you do have to leave at some point during this, this will be posted. So feel free to email me even actually, and I will send you a copy of this presentation via email if you guys need to head out. I will send my email in the chat right now. Now, these 3 things we're going to talk about. First, let's talk about the machine, okay? Before we get into the machine, let's talk about, where is it? All right, the page changed. Yep, we're good. Let's talk about money. And the more I studied money, the more I studied how I can make money work for me, the more I realized I don't know about money. The more I realized it's a long journey of financial education to really understand everything. There's always something new to learn. And so when I pose this next question to you guys, I pose it because I want you to think about it. Genuinely ponder what I'm about to show you. Are there more, or could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Think about that. Now, I don't think we'll ever get to a point where we know everything there is to know about money, but this is a powerful question because I want you to think about what you're not already thinking about, what you haven't been taught. And I hope when it comes to money, we can kind of have a humble learner mentality throughout our life. And so I'm sure you guys have read, Rich Dad, Poor Dad and different money books and business books, Money Master the Game, those type of books. What does everybody say? Anyone who's telling anything about financial education, one of the main rules they say is you have to be able to save money. You can't save money, you're never going to build wealth. And most people say you should save at least 10% of your income. I hope most of you here today do that. I know it's hard in today's economy, and the actual average American saves about 2 to 5% of their income, and that's simply not enough. In our American culture, we don't value savings. We don't value the retention of our dollars in our control. And I think the main reason I'm convinced that we don't save money is because the environments or the places that we're told to store our wealth. We're told to put it in commercial banks, places like high yield savings accounts, in our business, 401ks. These are so incredibly inefficient environments that it's hard to save money because the money we place in these vehicles don't do anything. And so what I'm going to talk about today is not just where you can store your funds that's more efficient, but then how you use it. Remember the machine, how your money runs through this machine. And that activity of your money moving is called banking. And so I'm going to talk about banking today. And that's a major paradigm shift for most people when they start learning about it. Because banking actually affects every single component of your life, whether you understand it or not. So wouldn't it be smart to learn a little bit about that banking function or banking activity going on in your life? So again, I want you to have an open mind, because once you see the banking world and how it actually complements your life, you're never going to be able to look at money the same way again. And so I said that I was going to teach you guys today how you can set up your own bank or be your own bank. Well, what if the bank you were going to set up was going to replace your current bank, replace the current place you store your money at somebody else's bank? Anytime you ever needed to buy something now or invest in something, that money would come from and to your bank. Well, let's start with a few attributes of what I'd want your bank to be. And let's compare it to a traditional bank. I would want my bank to be liquid, right? Duh, I need liquidity to do what I need to do in my life. That's goal number one. The average savings account right now pays 0.07%. I know there's some that pay more and some are great, some are bad. But that's the average. What if I told you your bank was going to make 2 to 6% guaranteed, uninterrupted, and compounding forever, never to be touched? Okay, that's cool. What if I told you your bank was going to grow tax-free? Whereas when you get that 1 cent of interest in your bank account, it's taxed. What if I told you it was going to be protected against lawsuits, judgments, liens, sometimes divorce and bankruptcy in some states, and stable? In 2008 and 9, over 240 banks went bankrupt. Not one of these type of banks went bankrupt. They were stable and profitable, even in down economic times. So yeah, look at that list. Wouldn't this be a much more efficient place to store money, to store our wealth? And this is outside of the commercial banks. This is a private place you can count on, you can control, you can use as the foundation to finance everything you need throughout your life. And I understand too, being in this world, being in 2025, life's chaotic. There's all kinds of stuff going on. So the opportunity that this could provide you to put money somewhere that is still liquid, still compounding, guaranteed, tax-free, risk-free. Yes, risk-free. And what if I was to add to that, if you were to take money out of your bank, it would not stop the dollars from compounding? I'm serious. That is something every business owner should dive deeper into. So wouldn't you guys agree that if you could store your funds here instead of the commercial system, you would? So what is your bank? We can finally get into it, guys. I've been dangling the carrot for this whole time. Here we go. What is your bank that we use? What is the machine we run our money through? It's none other than a dividend-paying whole life insurance policy from a mutual company. Now, before you guys head out and leave and think I'm some scammer selling life insurance, calm down. Why do we use life insurance? What the heck does life insurance have to do with building wealth? Well, it's because that's what the rich do. It's what the wealthy do. It's what the banks do. I will prove it to you. Let's start with who uses this. Top left, John Rockefeller. He built a massive empire in America where his family today is still wealthy by using whole life insurance. Guess how Walt Disney on the top right started Disneyland? Using his whole life insurance policy. Look it up. These two billionaires on the bottom right, we all know in today's world. Guess how much life insurance they have? Did you guys know Warren Buffett even owns an insurance company? I wonder why. These two politicians on the left, I know, sorry, this presentation is outdated. I should show Harris on here. But both of these individuals, both of these families, no matter what side you're on, have whole life insurance policies. And not, you know what's crazy is yes, these people do this. Yes, they have. Yes, they will. But guess who the number one purchaser of whole life insurance in the world is? Bet you wouldn't guess it. Number one purchaser is, drumroll, banks. Fascinating. Bank-owned life insurance. Look it up, BOLI. These are the top 4 banks. Look how much life insurance they own. Absolutely crazy. And guys, this is not, well, actually, you know what you'll actually find is that banks own more whole life insurance, not IULs, VULs, ULs of any sort, term policies, whole life insurance, than they own in land and buildings combined. Banks are the actual number one purchaser in the world. Not only do they own a lot, they keep buying it. They buy more and more every single year. So you need to ask yourself a question here. Are banks stupid? Or do they just know something that we don't know? Guys, they have over $60 billion in whole life. Just these 4 companies alone. They're not stupid. They're smarter than I am, smarter than you are. We just need to mimic them. And that's how we're going to become our own banks, is just copy what the banks do. So what do banks do when we give them our money? How banks actually work is, let's say you deposited $100,000 at the bank. And you had a great bank paying you 4%, stoked about it, right? Well, what do they do with it? They're going to lend it out. They'll lend it to somebody at 7% on a mortgage to buy a house. Who's going to pay their seller at closing? Who's going to put the money where? Right back in, right? So then what's the bank going to do from there? Well, lend it somewhere else. They'll go lend it to somebody buying a car at 8%. And when they pay the car dealership, where's the car dealership going to put the profit? Who's going to lend the money back out? The bank, to somebody doing a home remodel loan at 9%. And they're going to pay the contractor, who's again going to put it where? Who then could potentially get into some debt, need a debt consolidation loan, pay off 12% credit cards, and pay back the bank. Guys, look at this circle. Who's in control of all of it? Who's in control of all of these transactions, and who's taking almost no risk? Not the contractor, not the home buyer, the bank. How freaking awesome is that for the bank? While you're making 4%, they're making 7%, 3% spread. While you're making 4%, they're making 4% more. They're making 9%, and they're making 12%. If you total all of those up, they're making 20% more than you are on your money each year. Let's do that math. If you are making 4% and they're making 20%, they're making 5 times more than you. They're making 500% more than you are on your money in a given year. 500. If you look up BauerFinancial.com, you will read that banks make between 400 and 1,300% on the money you leave there. That's an actual report. There aren't banks that make less than 400% annually on your money. So when you guys go into any city, any town, any large place in America, who always has the nicest property in town on Main Street? The banks. We're paying for it. So earlier, when I told you guys that these banks are the number one purchasers of these specially designed whole life insurance policies, number one purchaser, the thing I said was, are banks stupid, or do they know something you don't know? You probably now know and should know banks are not stupid. They are smart. They know something we don't know. And banks aren't just smart. Banks understand how to finance things, just as we should. We are going to become the bank. We need to take over the banking activities in our life. Actually, if you guys look up banking on Google right now, it'll say banking is the business of protecting money. Interesting. You look up what's the verb form of banking. It says banking is depositing money, lending money, and protecting money. So anytime you deposit money or lend money, you're doing it in somebody else's bank and you're banking with them. Why don't you just bank with yourself? Be the bank by depositing your money in a specially designed whole life insurance policy that you own, you control, you earn interest, has all those attributes I mentioned 2 minutes ago. You get all that. And you can leverage it to do whatever the heck you want. That's control. I'm not saying the policy is going to be a better investment than the S&P. Not at all what I'm saying. I'm just saying it's a more efficient environment to store money than elsewhere. And I'm going to show you exactly how that works with this next example.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club is for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
I'm going to show you how you can buy a car from a policy and get back all the money you ever put into it, okay? And there's going to be a lot of numbers here, so if you're a numbers person, write this down, copy it, think about it, dive deep into this, or screenshot it and think about it later today. But we're going to go through some examples here with a lot of numbers. This chart here on the right shows you a policy example, and I'm going to dive into this in like 2 minutes, so just don't get too deep into it. It'll confuse you. Move my head over there. All right, so what we're going to talk about today is the machine, the policy that we're going to use to finance the car. And there's 3 things I want to highlight when talking about this policy. A lot of people look at life insurance and say, there is a premium. That is bad. That is an expense. I hate my premiums on my car insurance, my health insurance, my home insurance. You're right. Those are bills. Those are expenses. But what if what you paid or whatever premium you paid into your life insurance policy was safe, available, and earn interest? That doesn't sound like a payment. It sounds more like a deposit, somewhere you can control a deposit in your own bank. So I'm going to start referring to your premiums or how much you pay into your policy as a deposit. And people also say, well, I'm in my 50s, I'm in my 60s, I can't do this. Well, not true. Sure, you might be older. Sure, you might have a smaller death benefit than somebody who's younger. But that doesn't mean you can't put money in life insurance and leverage it and get interest and have liquidity. You still get the same benefits. So age does not matter. And last, the death benefit. This is life insurance. You do have a death benefit, and you will cover your family for your entire life with this death benefit. That is a massive benefit on top of everything I've discussed. But I'm not going to build this insurance policy around you having the largest death benefit possible. I'm not building this for life insurance. I'm going to build the policy for banking. And if it has a big death benefit, awesome. But I'm not going to build this for it, if that makes sense. So let's show you how we're going to finance a car through a policy. Remember, there's premiums you have to pay into the policy. I call it deposits here. And this individual we were working with said that they saved 10 grand a year. And they just put it in their savings account. I said, great, save it in your policy. 10 grand a year is your deposit. He could fund that monthly, annually, once a year, twice a year, whenever he wanted. But he put in 10 grand every year. And on the right side, it shows you the cash value. Cash value is how much liquidity you can use inside your policy. It's what's available. So year 1, he had access to about 6 grand. Put in 10 grand, had access to about 6. Okay. Year 2, he puts in 10 grand, had access to about 12. Okay. That's cumulative, growing year to year. Year 3, it drops to 4,000 because he takes out $25K to go buy a car. So you take a $25,000 loan, you go buy a car. Okay. So you paid $30K into this. You take $25K out as a loan. Let me highlight that real quick. This cash value. Whenever you touch this cash value and use this, you are taking a loan against your policy. It is a loan from the insurance company with their money that they're lending you, that you owe interest on. So you take the $25K as a loan against the insurance company, against your policy, and you go buy the car, cash. Go to the dealership, pay for the car. And then what are you going to do? Well, if you're going to be your own bank, you're going to take a loan from yourself, wouldn't you pay your bank back with principal and interest? Right? So you would pay yourself whatever payment you would pay somebody else. You'd want to be an honest banker with yourself. You're not going to steal from yourself, take a loan and never pay it. So we're going to pay ourselves back $500 a month for 60 months, just like any other car note. So that's what I'm going to show you here. After 7 years, you've paid, or this individual paid, $70K in premiums. He paid $30K back to his policy to repay himself. And he took out 25. So he put in 100, took out 25. So his net injection into this thing is like 75 grand. He put in 75 over 7 years. And look at his cash value. His cash value after 7 years is $67,881. So you put in 75 and you have 67 left over. You have access to 91 cents on every dollar you put in. You have access to 91% of everything. Or in other words, you just got 91 cents back on the car you just purchased. What's the difference between 75 and 67? It's about 68. $7,000. So you don't have access to $7,000, but didn't you buy a car for 25? You only lost 7 grand on the whole transaction. And I wouldn't even say lost it because you still have a death benefit that paid for. Okay, that might have made sense. might not have. I'll show you another example. Let's say in the next year, this person wanted to take out another loan from their policy and go buy a car. And let's also say that they did not want to pay any more into it. Let's say they were in retirement age, they didn't save any money anymore, and they were just living off everything. They couldn't fund their policy. So they stop. They take out another 25 from their policy, and they repay it again, $500 a month for 60 months, just like they would pay any other bank on a loan. Okay? They've paid zero money in premiums. They paid $30K back to the loan that they took out, and they took out 25 to buy it. So they really put in $5,000 into this thing over the next 5-year period. From year 8 to 12, they put in about $5,000. That's the net. $5,000 they put into this. Look at how much the cash value grew by. It went from 67 to 91. Their cash value grew $23,000, and they put in just 5. Now think about that. They put in 5, they made $23,000 off of buying a car because they took a loan from themselves, they paid themselves back, and all those money transactions happened in their own private system. So they, and one more thing I'll highlight actually, all these premium deposits over that 7-year period, when you paid into the insurance company, remember what your deposits do. They're guaranteed to grow, they're liquid, they're tax-free, they're protected against lawsuits, judgments, liens, and they're in a stable environment. So this $70,000 is earning interest and dividends. So what do you think 70 grand over 12 years is going to do with compounding interest? Right? It's compound itself while you leverage it, take out a loan against that appreciating asset, and you go buy a car and pay yourself back. Remember the example in the beginning. Can you earn more earning 4% than paying 6%? You could. So what if you just accelerate and expand that concept to letting all your money compound forever and then leverage it to finance anything you need to? That's what we're highlighting here, is taking a loan against yourself to buy 2 different cars. And by doing it, you're making money. Look, you've put in 75 grand in the first 7 years. You put in 5 grand in the last 5 years. You put in 80K into this thing over 12 years. You have 2 cars fully paid for in the driveway, and your cash value is 91 at the end. You have 91 grand left over after putting in 80 and buying 2 cars. That is powerful. And this is because you are in control. You are the bank. You are financing things from yourself. There's 3 rules we incorporate when we do this. Rule number 1, pay yourself first. He paid himself 10 grand a year before paying anybody else, before saving it anywhere else. Rule 2, pay yourself back, and pay yourself back with interest. Rule 3, recycle and recapture your money. What I mean by that is would you rather pay interest to somebody else or pay interest back to yourself? That's what you're doing, is you're recycling that interest because you're not paying yourself what you would have paid somebody else. So those are the 3 rules with doing this. So if this works for a car, what else does it work for? Everything. Anything. The next example I'm going to share with you is paying debt off, because a lot of people tend to come to us with debt and they're looking to pay off their debt through a policy. And so they say, hey, well, I save a certain amount per year, and I'd like to use that savings to pay off my debt. And right now, I'm just paying extra on my credit cards and such. How can I do that more efficiently? And we would tell them, hey, run it through a policy first and then finance it. Okay, I'll show you what that looks like. Here you go. This is a chiropractor who came to us. Chiropractor in Kansas City. He was saving 2 grand a month, just extra cash flow from his business, about 25 grand a year. So he said, hey, I'm going to put in 25 grand every year into this policy. We said, great, let's do it. And we will use this policy to strategically snowball down his debt. These were all of his debts. That's a lot. Look at all the payments, the interest. He had a total of about 500 grand, which was about 6 grand a month in payments. Some of you probably relate to this. It was going to take him 19 years to pay it all off, but not with our method. I'll show you how. Year 1, paid in 25 grand into the premium. He had cash value available to use to leverage, about 15 grand. Took that out, chunked down his credit cards. Now he no longer has those 2. Awesome. What is he going to do now? He takes a loan from himself. He should pay himself back, right? We went through that example earlier. So if he no longer has to pay $161 a month on the Discover card, you can see here, and $287 a month on the Lowe's card, well, then what's he going to do with those payments? He's going to start paying himself back, just redirecting who he was paying. He's still going to make those payments, But instead of putting 448 to those creditors or just saving it in a savings account, he's paying himself back, just refilling the policy. So year 2 rolls around, dumps in 25 grand again. He had access to 16K in his cash value. And then because he repaid himself 448 a month, he repaid himself $5,000 throughout the year. So year 2 comes around, he has access to about 22 grand to use to chunk down his debt, pays the next 3 debts off. All that's left are the 4 big ones. Look at all those payments he just freed up now. What's he going to do with them? Pay himself back. So it's $1,900 a month now. He's repaying himself. Next year comes around, 25 grand goes in. His cash value is 25K. He repaid himself $1,900 a month, about 23 grand throughout the year. He has 48 in hand to now use because the cash value and the repayments, right? He chooses to pay down the next 2 debts, a little bit of the condo, frees up those 2 payments on the BMW loan and the boat loan that he had. And now he's able to save $3,600 a month. And we're just 3 years in. Remember, if he kept going the traditional path, it was going to take him 19 years. We're 3 years in and everything's gone but the houses. So, little recap for everybody, just to make sure you're on the same page with me. And if you guys have questions thus far about those numbers, please put them in the chat. But this is a marathon. This takes time, right? This is not a quick scheme to get you debt payoff in a month. This is going to take a long time, but it's more efficient. How much money did we put in? 25 in year 1 and 2 and 3. That was what he paid into the policy. 75 grand. What did he take out as loans from the cash value? 14 in year 1, 16 in year 2, 25 in year 3, 55 in total. So how much is left in your policy? What's left over? Some would say 20. I feel like our chat today is smart. You guys that are here for multiple times, what's actually left over in the policy? Guys, 75. His entire 75 grand is still inside the policy, still there, earning interest, guaranteed, tax-free, with the death benefit protected. And he took out 55 as loans against his policy. Yes, paid off his debt, freed up payments, paying himself back way quicker, and paying himself back, not somebody else. And he still has his original principal compounding. That's the power of becoming the bank. So let's continue on this path. Next year, same thing, cash value, repayments, pays down the condo. Next year, 25, cash value, payments, pays off the condo. Following year, year number 6, he came to us and said, hey, my business is more tenured. I save more money. I make more money. I'd like to set up a new policy this time on my spouse. So he set up a second. And he said, I want to decrease some contributions on my first policy and just do more on the second one. So that's what we did. 10K onto his first policy. His cash value grew by 13,000. He put in 25K in the second policy and had 14K available in cash value because that restarts to year number 1. And so he had all that cash value available, and he repaid himself throughout the year. So he had a ton of money to pay off the house and be done with his debt. A lot. Took 6 years. 6 years to pay off all of his debt instead of 19. It's powerful. And not even just that. He's able to pay himself back and pay himself back with more. I'll show you that in a second. But a lot of you might be asking now, what if I don't have bad debt? What if I don't need a new car? Guys, it just gets fun. It gets better and better. I don't have debt. I don't need a new car. I'm using my 4 policies that I have to buy real estate, to do syndications, to lend, to produce passive income. It gets a lot funner when you start building into that wealth aspect and not just paying off debts or purchasing stuff. Most people start with the debt, start with purchases, get their life in order, build a foundation, and then they dive into investing, and they have such a strong foundation to do it. It's game over. There's no way you don't become wealthy. And so if you were to pay off those houses and pay yourself back just as you would have paid the bank, I love showing this because I think it's so interesting. He had 251 months left on his condo payments and 224 left on his house. He was going to pay 500 grand over the next 250 months to the bank. But because he financed everything himself and redirected all that debt to be in his own private system, he's going to repay all these payments back to himself and save and recapture, recycle 500 grand. That is powerful. Don't we all want to do that? Right? So now that you guys know this, now you know how to do this. You've seen multiple examples. You guys are now pretty much experts on this concept. Everybody should be doing this. And if you don't, you're just stealing from yourself, your kids, your grandkids. You're not passing down the wealth to them that you could be. And so if you guys continue on the same path that all of us Americans are groomed to follow. We're just going to stay in debt, stay with a poor money mindset, and not build anything for our families. And it doesn't matter whether you make $10 an hour or $10,000 an hour. It really doesn't. We have people coming in from every aspect of that spectrum, and this works for everybody. Wealthy people do this for a reason. Banks do this for a reason because they know what it can do and they understand how to keep money in their family and in their control. So let's just copy them. Guys, when you use infinite banking like we show you, like I want to help you do, you're going to make that money go and work for you. Right now, we're constantly trading time for money and not doing anything else. It's a vicious cycle. It's hard to get ahead. It's hard to actually build any wealth because the money is not working for you. You're working for the money. So infinite banking, the strategy of banking is all about controlling it. So just to wrap up today, I'm going to go through some frequently asked questions, and then I'm going to ask you guys what questions you have, and we'll finish up. I already mentioned some of this stuff. I might as well just skip this page. You can use policies for retirement income, for policies on your kids, to finance college and businesses. Just a quick highlight. How do you fund a policy? How do you fund your bank? Well, you fund it at whatever frequency you want. The minimum I'd recommend for you to do this, if you are not in a position where you are saving 10 times your age a month, you are not in a position to set up a policy. I would say the minimum you should do on a policy is 10 times your age a month. If you are 50 years old, add a zero, that is 500 a month. If you are 30, add a zero, that is 300 a month. If you are not able to save at least that, this is not worth your time yet. Go build a foundation of increasing your income, having less expenses, finding ways to save more money. The maximum depends on the individual. We have people putting millions of dollars into these policies. So the max depends on you. And on top of just funding your policy consistently every month, every year, you can do a large lump sum to get it started. Not required, not needed, but you can. If you have money sitting in a savings account, you want to just dump in to get it started, go ahead. You could do $500 a month and then dump in 20 grand or something like that. So definitely an option. And you will have access to 60 to 90% of that total deposit in the first 30 days. This is why this is so powerful. You do not have to wait a year, 2, 3, 4, 5 to touch your policy. In the first 30 days of it being started, you can start accessing the cash value and leveraging it to pay off debts, make investments, and do exactly what these examples were that I just shared with you. Policy loans, cash value loans. The policy loans are guaranteed. They will give you the money no matter what because it is written in the contract. The policy money, the cash value loans are yours. There's no credit check, approval, paperwork. Ask for a loan, they send you the money. It is that easy. Because again, it's written in the contract to be legally yours. Loans are private. They do not go on your credit report. So how cool would it be if you had a bunch of debt to pay off all your credit cards, all your third-party stuff, redirect it into your policy so it's in a private place. You still have the debt per se, you want to pay it back, but now it's off your credit report and now you can qualify for a mortgage or something. So they do not go on your credit report. Policy loans are private. And there is no minimum or maximum of how you repay yourself. And if you missed a payment paying yourself, nothing happens because it's against yourself. You're in control of it all. Why the money multiplier? Why our company? Why me? We've been doing this for over a decade. We learned from Nelson Nash, who started this strategy and founded the name. We have over 20,000 families across America we have met with. We have a team full of specialists of all aspects of financial education that can guide you on how to use your policies. And everything we do is free. There's no charge to you by any means. You set up a policy, we'll help you build it, we'll help you make sure it's structured right. We'll go to the insurance company with you that we prefer to build these policies. You'll get it set up with that insurance carrier. And then after it's set up, we will show you how to use it. If you're like, hey, I want to pay off debt like the chiropractor, cool. We'll build you your own spreadsheet of how to pay off your debt, just like the chiropractor. Hey, I want to go buy a car or buy a rental property. How should I do that? Here's how. I'll show you just from my experience exactly what I even do. Last thing I'll mention here is a lot of people in the financial market right now and on social media talk about IULs and VULs. I will not talk a lot about that now, but you cannot use those type of policies to do infinite banking. There's an extreme amount of risk involved in those policies, and it does not work to do banking the way we teach. You need a specially designed whole life policy, and you can't go to your local insurance agent, your brother-in-law who sells insurance. You can't go to somebody you know and get insurance policies like this. We have thousands of financial advisors and attorneys and CPs that come to us and ask us how we even build this because they don't know how. They weren't taught how to do this because why would they? These are not profitable products for an insurance agent or company to sell. term insurance is. Hence, buy term, invest the difference. It's the most profitable thing for them. Whole life is profitable for you if it's built correctly this way. So to wrap up here, everybody, only one or two things are going to happen to us in our life. Well, both are. Actually, we're going to live and we're going to die. So I showed you why you are better off with this while you're alive. You can pay off debts, finance stuff, invest, do whatever you want to do more efficiently. And when you pass away, in this model, your family gets a large lump sum sent to them in the form of a death benefit, tax-free. If you don't have a policy, they get nothing. Your family's way better off with this than if you don't have it. And last, I want to talk about Mr. Warren Buffett. I hit him earlier. I want to hit him again. He says if poor people would just do what rich people do, they wouldn't be poor anymore. Guys, why does Buffett have an insurance company? He knows what he's doing. Why aren't we taught these strategies? Because it helps the commercial banks, helps the financial system, not us. Guys, I will personally meet with every single one of you for free. The whole process is free. We're paid from the insurance companies for the business that we bring them. We're paid from them. There's no cost at all for you doing this. We're not here to manage your money, touch your money, invest your money. You build your own private banking system. I will help you do that. Look up carson.beyourownbanker.com or email me at carson@chrisnaugle.com. I will build for you your own personal model, your plan, your policy that you can use. I will throw these in the chat as well. Guys, there are probably a lot of questions you have around this. If you just want to have a quick call and go over some questions that you wrote down today, let's do it. I'm here to help. Don't be scared. It's time to take action. There's no way you will be able to build wealth without doing so. So shoot me an email with your questions. Carson@chrisnaugle.com. Look that up. Send me an email with all your questions and I'll answer them. I won't do it here, I guess, anymore. So let's look through the chat. Yes, I can send you a copy of the recording. I'll save your email here. Please email me your questions, thoughts, concerns. If you want those questions answered more specifically, schedule time with me. Click that link in the chat, carson.beyourownbanker.com. I'll throw it in here again. There it goes. Someone asked what happens to your money and your policy when you die. The death benefit gets paid out to your family. Any other quick questions? We good to go? You guys have my info. I love you all. Appreciate it. Have a happy new year. Have a great 2025. Next Tuesday, every Tuesday, we do this similar presentation because this concept takes time to learn. Keep coming back, keep learning, keep being here. Appreciate it, guys.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.